welcome back. Thanks for hopping on. This is my way in a COVID environment of staying in touch with you, my clients, and then we have advisors that may be on the call with their clients, and welcome. And this format is really about education and taking little nuggets of information that we've learned along the way in our financial careers to help share them with you so that you can understand the impact of changing your way of thinking going forward. So today, the topic will be on taxation, fixing the time bomb. And this will be a little bit of audience participation. So as I go through the slides, I'm going to try and keep this to under 30 minutes. I may get into a little bit of the weeds depending on how well you can read and see the screens and the numbers. But without further ado, let me ask this question. What do you think taxes will be in the future? You personally. I want you in your mind, your heart of hearts, to think about what's going on. So do you think that our income taxes in the future will be lower? Do you think they might, for you personally, remain the same? Or do you think that they could possibly be higher? The answer to this question should determine how and where you save money. So I don't know if any of you have ever seen the US debt clock. This is not the running version, but if you want to see how alarming this is, go to usdebtclock.org and you can see this in real time. But I took this snippet last week, and currently our country is $26 trillion. That's with a T, in debt. Now, the combined debt of the entire country, and this is including individuals, is over $81 trillion. So, it's hard for us. We hear this word, it's thrown around very loosely, but mathematically, from tax revenue, they're only bringing in about $3 trillion a year right now. We have a little bit of a shortfall. If we were prudent financiers, we would know that saving money and paying off debt is just smart, right? And at this mathematical rate, it is unlikely that this country can pay this debt as it stands right now in its current tax environment. But then you add roughly $6 trillion of COVID relief on top of this 26 trillion, and it's alarming. So does saving for retirement in a tax, and I use a little different word, instead of tax deferred, which is typically the word that is utilized for savings vehicles like IRAs or 401ks, I use the word tax postpone, because postponing something is usually synonymous with something that doesn't have a good outcome, right? So does saving money for a tax postpone in a tax postpone environment make sense? Well, let's apply math. And we're going to use a tool that I've used with our advisors over the years, and we call it the horse race, right? Give it a little bit of levity to help you to put it in, say there's 3 horses in this race. Now, this chart is going to take me a little bit to point out to you. And this calculator, and this is why we're just applying math, is saying, hey, if we put $10,000 a year for 20 periods, we give the crediting rate and interest rate all the same, equal across the board 10%, right? Just to keep the math simple. And then we say that the tax, both up the mountain or the accumulation and down the mountain, are identical. 20% is the taxation of the account as the money went in and the money went out. You can see that there are 3 categories, 3 horses in the race, and they've been color-coded. So taxed annually is the blue. And you will see throughout this race in the alternatives that saving money in this fashion is absolutely the least efficient mathematically, all things being equal. But then we have tax postpone, which is like our 401k or IRAs, that's in the yellow. And then tax advantage, right? And that would be something like in a Roth IRA or a cash value, property structured cash value life insurance. But all 3 of those, and here's the point I want to make here. If the tax environment going up the mountain and the tax environment when the money is withdrawn stays the same, that tax postponed, like your 401k, is exactly equal to if you did a Roth 401k. Exactly the same. So it's a tie, right? So the net spendable income, a little over $1.3 million, taxes stay the same, it's a tie. But let's say that taxes are lower for you in retirement, which is the bill of goods that we were all sold when we signed up for the 401k or IRA, that tax deferred plan, because, all the pundits said, hey, when you retire, you will be in a lower tax bracket, therefore saving money when you're in a lower tax bracket in retirement makes sense. And if it is in fact true for you, you will see in the same puzzle, even a 10% increase in the taxation rate that you're actually paying from 20 to 30 on the accumulation. So you were in a 30% tax bracket in your working years, but in the distribution years, you are in a lower tax bracket, that now the 401k wins. And, so you can see that you have some spending money and extra left over at the end of a 40-year period. So if taxes are lower at retirement, IRAs, 401ks, TSPs, tax shelter plans, right? The tax postponed or tax deferred arena wins. That's the horse to bet on in that example. But based on that calculator I showed you earlier, is that really the case? And if the government needs money, one of the things I will often share with folks is that there are no lobbyists in Washington lobbying for your 401k. They might lobby for taxes, but if they ultimately decide that this country needs money, the only untapped resource that they have is this area where folks are saving trillions of dollars because it's what they thought they should do and what they were told to do and what their coworkers should do, only to pay more out the gate. And if that happens, so now let's take the opposite, right? So we're saving the same $10,000, same 10% crediting, but now we were taxed at 20%, but 10% on the outset, on the downside of the mountain. That small 10% increase has a significant difference because now, right, we have more spendable income in the tax-free arena. And this is why we're huge proponents of taking and starting to shift and unwind this ticking time bomb. So tax advantage wins if taxes are higher in the future. I've had several calls in the last 2 weeks with folks that are high income earners. And as I was asking the questions, quite often they'll say this: I already have a financial advisor. I say, I said, that's awesome. I would expect that you do. Question for you, Mr. and Mrs. Client. What is your plan to divorce the IRS and get out of your 401k should taxes go higher in the future? And it is always crickets. Arguably one of the smartest men that ever lived, he's going to have said the hardest thing in the world to understand is the income tax. And it's absolutely true. When I bring up taxes, and I can see the glazed look in their eyes, the deer caught in the headlights. It's confusing. I mean, we have over 72,000 pages in our tax code in the US. But there are absolutely legal strategies that you can do. But one of the things I will tell you is it's already a fact that your taxes are going up in 4 years, 5 years. We're in 2020, almost 2021, and the TCJ Act, the Tax Cut and Jobs Act, that went into effect in 2017, to the left of the screen is for married filers. That's what our tax bracket was. It is set to sunset in 12/31 of 2025. What that means is on January 1st of 2026, the taxes that are on the right side, the tax bracket, it's like a graduated cylinder when you were in chemistry class, will now shift to the format to the left. So what you see on the right side of the screen, whatever your marginal tax bracket is, will overnight go to the left side of the screen. So if you are in $160,000 combined married filing jointly income, that combined tax bracket right now is 22%. But overnight, That same 160 will go to 28%. It will go up to the next level. And here's what I said. You go, well, 3%, that's not going to make that much of a deal. That's just in a few years, right? We saw the impact that 10% increase will have on your taxes, and the government needs a lot more. So bottom line is you should pay close attention, not only where or how you're saving the money, but the environment that you're saving your money. And there are strategies that you can do, in the accumulation phase, but also in the disarming phase and the unraveling of, if you've already entered into these arrangements, right, depending on your age, depending on the strategy, depending on what you're looking to do, we can, especially with the Secure Act, where they've extended out RMDs to age 72, there are things we can do to unravel these ticking time bombs, because it's going to get to a point where the government is absolutely starved for revenue. And what they're going to do is just pass laws that say, you know what, we have no choice but to tax these accounts at a higher tax bracket. So you should consult with a professional to disarm these ticking time bombs. You know, I would consider myself well-versed in this arena, but whether it's with me, the advisor that invited you on this call, or somebody that you know and trust, make sure that they're giving you good, sage advice, because I'm telling you that the same old strategies of the past are going to hurt you in the future. Don't procrastinate. Do something now. Get a second opinion. Find out what your options are, because once they change the rules, you're now married to the new set of rules. So whatever steps you can take now will absolutely help you and protect you and your family and legacy planning into the future. So if not me, somebody like me, but don't try this at home unless you've been trained. This is an area where I would absolutely caution doing this yourself. I had done an event at Rutgers, and when they came into my office, they got the concept, they got the message, but it wasn't made, I guess, apparently in the 2.5 hours that we had spent that night predominantly on taxes. When I said that we should really give strong consideration to unraveling this tax bomb, this gentleman was 50 years old, and he wanted to take his whole $500,000 and do it all in 1 year. I am absolutely telling you that's probably not your best option. You are absolutely going to get crushed in taxes and penalties. We have to be strategic in how we separate. And that's why time can be utilized in a strategic fashion to preserve your accumulation and wealth. So I'm at the end of my topic hour. This is our disclaimer from my RIA, just saying that, hey, listen, this is my opinions and just my disclosures. And then lastly, I want to thank each and every one of you that are on the call. I wish you all the best. I hope to see each and every one of you soon. If you need me, call me. And also thank the advisor that invited you on this call. And if you have any questions, reach out to them as well. Bye-bye.